Well, first a postscript on Qantas. Here's a chart of its share price and the All Ordinaries Index over the past 12 months. The market has fallen 8%, but at the start of October, Qantas was down more than 50%. Now, whenever that happens to a company, something has to give, and it did. The market fell more than 1% today, although half of that fall occurred after the bell, when off-market transactions get shoved through. So it's hard to know what happened there. Resources stocks and financials all fell pretty heavily, although Woodside bucked the trend with a rise of 1.5%. And as you've already heard, Qantas topped the rises with a gain of 4%. US and European markets were steady on Friday after the big gains on Wednesday and Thursday that followed the third or fourth declaration of solvency in our time in Europe. The euphoria didn't last much after the weekend, though, as investors started looking into the fine print of the Greek bailout deal and discovered there were more holes in it than in the walls of the Parthenon. The Australian dollar also fell for the same reason, down from 106 on Friday to 105 today. Some data on lending came out today. Private sector credit rose a little bit in September, nothing to get excited about. Certainly not enough to prevent a rate cut tomorrow, if that's what the Reserve Bank has on its mind. The annual growth in housing loans is the lowest on record, and that's reflected in house prices. The latest figures today show that the national capital city median price fell 0.2% in September, the 9th consecutive monthly fall. The good news is that it's the smallest drop for 7 months, and as the chart shows, the decline is a gentle slope for all types of houses, unlike the US. And that's finance.